Hi friends, my name is Rahul Jain. I am a SEBI registered research analyst. There is a lot going on in India as well as in Indian stock market. For example, recently US announced tariffs for pharma companies. They are not going to be there for the next 2 years, but after 2 years, 100% and 200% tariffs are coming in pharma companies. Also, Trump announced fresh tariffs on countries like us. From 12.5%, it's gone down to 10%, but there is a lot of noise because of these tariffs. Protests are going on in our country. So there is a lot going on that investors have to chew in right now because of so many things. And for example, today itself, when I'm recording this video, Sensex is down almost 900 points. And there are multiple reasons of why the market all of a sudden has come under huge pressure. This news also came out just few hours back where Trump is considering a massive attack on Iran. Now, when all of this is happening, as an investor, there is a lot of caution that you need to exercise in the market. Right now, Indian stock market as well as US stock market or even global stock market, you really need to be careful. What is the outlook going to be now in the next few weeks, months? Is it going to present a lot of good opportunity for buyers, or is it a time to sell off because of a lot of risk? All of this clarity will only come if you understand one important point, which is US-Iran wars restart. Important point, very, very important point, that is injecting massive risks into Indian stock market as well as US stock market. In this video, I'm going to speak about that particular risk, break it down for you. Also speak about valuations of broad indices that you need to understand. We'll speak about few of the Google and Microsoft and those companies as well in terms of what is happening there. I'll try and give you the rounded view of what has been happening in Indian stock market as well as US stock market in the last few weeks. Very, very important video. If you're new to my channel, hit that subscribe button now. With that, let's get this video started. Allow me 2 to 3 minutes of time. I really need to explain to you why the US-Iran restart of the war matters now even more than the previous stage that happened. Okay, have a look at these timelines. War started 28th of February 2026. US-Israel both launched the strikes at Iran. Okay, now by the end of March 2026, Nifty made a bottom at around 22,800 level. Okay, this was the bottom that was made. War continued, negotiations started, April, May went by. 17th June 2026, there was a temporary memorandum of understanding between both the parties. Okay, that did not last even for 1 month. That means the little trust that these two parties had did not even last for 1 month. Okay, 8th July, Trump officially declared that the ceasefire is over now. Okay, and the war restarted between US and Iran. Every day the strikes were happening between these two countries. Till this time, I don't think there was a newly injected risk in the stock market. Okay, what happened on 24th July is something very, very significant when Houthis joined this particular war. Now, I'm not a war expert here and I'm not trying to give you any geopolitical aspect of this, but Yemen's Houthi group started attacking Saudi tankers, and this is very, very significant for our Indian stock market. Why? If you look at this map very, very clearly, Strait of Hormuz is now closed, but this strait that you see, Bab al-Mandeb Strait, which is controlled by Yemen's Houthi group, this is now coming at a risk. This is coming at a danger now, because if the oil doesn't pass through this particular strait, then the shock of the oil is likely to be more than what we saw in the previous stage of the war. And that's why precisely, if you look at the crude oil prices, it has gone back up to almost 100, touching very, very close to 100 now. In the month of April, May, June, it started to come down, went down to almost 70. And we were thinking, you know what, this market risk is over now. Market should look forward. This war is done and dusted. But actually, that risk has re-emerged now. Oil has gone back to almost 100. But more importantly, the war situation is worse now. Why? Because earlier, at least, there was a hope that these two countries will have peace. Now that trust is also broken. So we don't know how long this war can drag out from here on. And that is what investors are worried about. And you can see all of this in FI selling data. For example, if you see 3rd July, 6th July, 7th July, 8th July, 10th July, this week was full of FIs buying Indian stock market back again. But as soon as on 8th of July, Trump declared that the ceasefire is over, see what happened to FIs selling. It went up. From 13th July onwards, they have been continuously selling now. Why? Because they're baking this risk into the market now. And this is the real risk on our earnings. Okay, it's not a joke. For example, if I show you the data, Q1 FY27 earnings have started to come out in the market. Okay, April, May, June, these were the 3 months where the oil prices were up, right? We all know that in the first stage of the war. Now, if you see the revenues of our companies here, for example, so far 404 companies have declared the results. And what has happened here? Revenues have grown nicely, 22%, 18.5% if you look at Nifty 50 companies so far. Large cap, if you look at 20.1%. Albeit these could be very, very misleading because it's only 400 companies so far, right? But if you look at the PAT growth of these companies, what do you note? 1.2%, 3%, 5.1%. Why? Because the oil prices were really, really high and the margins have compressed because of higher cost for the companies to execute their businesses, right? Very simple. So this is a danger. This is a real risk on Indian stock market, which is earnings growth. Now, we don't know how long this war might drag on, and therefore there is a danger in the market. Market may fall. All of the broad indices that have recovered. For example, if I talk about here, let's say Nifty 50, the bottom that it made 22,800, it was down by almost 15% from its all-time high. If you look at the mid caps, they were down by almost 15%. The bottom was at around 19,000. If you look at the small caps, they fell down by almost 20% at the time. It was at around 15,000, 14,900 level. There was a lot of recovery from that time onwards, but markets made a bottom at that point in time. So there is definitely a risk in the market, but at the same time, I also feel that there is an opportunity for investors here. Why? Because all of these things reversed, right? And the market did a very, very good recovery. Can that happen? We don't know yet, but at the same time, we need to be ready. If the market again goes down, there might be an opportunity to build some positions. Now I'm going to talk about valuations for Indian stock market in a minute. I will also speak about US stock market so that you get a rounded view of both the markets and you can decide if these are opportunities that might come your way. So let me speak about the opportunities and valuations for Indian stock market. Let me first focus on the large cap segment, then I'll come to mid and small little later. Okay. If I compare Nifty 50, Nifty Next 50, which is stock number 51 to 100, and then Nifty 100 as a whole, the large cap, what you notice from a valuations perspective, current PE ratio of Nifty 50 is almost at around 20. Long-term 5-year average has been around 22. So definitely Nifty is trading below that. Okay. Nifty Next 50 on the other hand, current PE is almost 18.7 and the 5-year average is around 23. Right? So this is massively discounted already, almost 19% below the average last 5 years. Nifty 100, 20.1 and approximately 5-year average is around 22.3. So definitely this is also trading below the 5-year valuations. Now let us imagine that the market starts to correct now from here on. Okay. Next 4 weeks, let's say market is down by another 10% or so, or maybe 15%. I don't know, right? We don't know what the shape of the market will be, but feels like that the market is likely to move towards the downward side rather than the upside, unless until there is some big deal happens between these two countries, which is looking very, very unlikely if you ask me right now. Okay. So let us assume that 10%, 15%, 8% market drops from here on, these valuations will also drop. Okay. Nifty Next 50 from 18.7 might go down to 16 or even 15 for that matter. Okay. To me, those will be the real opportunities for people who are long-term investors, not afraid for the short-term volatility, right? And have sufficient cash to deploy into the markets. Okay. That's what my thesis is. Also, if you question me that, Rahul, what about the earnings per share here? So what I've done is I've taken the estimates, EPS estimates for all the three indices here. Nifty 50 around 6 to 8%. Nifty Next 50 around 14 to 17%, Nifty 100 around 9 to 11%. Now, mind you, all of these are estimates only, but they are telling you relative position. Nifty Next 50 is likely to grow faster when it comes to EPS. So clearly, if I were to take any bets when the market falls, if at all it falls, it has to be Nifty Next 50 within the large segment. There is no doubt about it because you see the valuations, you go with the valuations comfort. Of course, not a recommendation that you go and invest. In fact, if you are worried about the stock market, if you're already seeing your portfolio in red, don't invest. It's up to you. It is your risk appetite. But if you're planning to invest, you really need to be cognizant of the valuations. You cannot just look at, okay, this is down by 8%, 10%, and let me go and invest. No, it doesn't work like that. You have to buy at good valuations. And we don't know what the downside may be from here on, but I feel like there might be downside from here on. Okay. Now, ETFs is a very good way of dealing with such situations. Index funds is a good way to deal with such situations, right? ETFs, I've gathered all the Nifty Next 50 ETFs in front of you. None of these are recommendations. I've arranged them in the order of 3 months average volume. How much average volume these ETFs have been trading with, right? You can see those volumes here. Tracking error, you can see. Lowest tracking error you can see is the last one at Aditya Birla 0.04. Okay. If you look at, for example, here, look at Nippon India Nifty Next 50 Bs, that one showing good volumes and the tracking error is also very low, 0.05. You can go and check expense ratio as well. But this is a good list to start with. Start studying these ETFs if you like them. Check the INAV versus the trading price so that you understand whether you're paying premium or not. All of those concepts I've already taught to a lot of you on this channel. If you're new to channel, hit that subscribe button because Gradually, your learnings will go up as you consume this kind of content. We're talking about valuation metrics, etc. Okay, so this is on the large cap segment. I'll come to mid cap and small cap also, and will give you a very, very important conclusion around mid cap and small cap where the growth is likely to be. Before that, let me also spend few minutes about the US stock market. Very, very important commentary I'll give you around US stock market that you need to listen for the next few minutes. Now, coming to US stock market, one of the biggest problem right now is the bond yields for stock investors. For example, if I talk about the 10-year treasury bond yields, they are almost at 4.7%. And when the bond yields are so high, what is likely to happen? Investors go for bonds because the bonds are giving them 4.7% of the yield. They would not bother, or they would reduce their exposure to the stock market, right? That's what typically happens. And on top, what is happening is Trump is pushing for Fed rate cuts while the inflation is going to be higher because of the oil situation. And if that happens, then Fed might not go for the rate cuts. In fact, either it could remain neutral or might go for a rate hike in the upcoming weeks. And when that happens, stock market is likely to get impacted. Okay. And this could be a great opportunity for people who are patient, who are long-term investors, because every panic, every dip might open up opportunities. Now, for me to practically show you some examples, I'm heading towards Vested, a US stock platform that I personally use. If you want to use it, I've given you the link in the description and in the pinned comments. If you use my link, you're going to get $10 as a bonus when you do your first funds deposit. Okay, the link is given in the description. Now, if I go and type here QQQ, which is an ETF by Invesco, and it tracks NASDAQ 100 index. What is happening right now? Okay, if I talk about the valuations, first of all, let me speak about valuations for a minute. So if I bring you the valuations of comparison of Nifty 50, S&P 500 and NASDAQ 100, which is being followed by QQQ. Okay, if you look at the current PE of all these three indices, US indices are trading at a premium. So NASDAQ 100 is trading at around 31.8 PE. And the 5-year average PE has been around 29.5. So this is definitely trading at a premium. Why? One of the reasons is the earnings growth rate. So if you look at the EPS growth rate for the last 12 months, Nifty has delivered only 6 to 8%, while NASDAQ has delivered around 18 to 20%. So almost 2 or 3 times earnings growth is what NASDAQ had delivered. And that's why it's been enjoying the premium. If you look at the next 12 months expected EPS, which is forecasted, Nifty is likely to do better, 11 to 13%. At the same time, NASDAQ is likely to come down to around 15 to 17%. But still, it is not a bad growth rate at all. Now, what happens if NASDAQ corrects? Okay, QQQ will correct. And let's say if this PE ratio comes down from 31 to let's say 27, 28, 26, I don't know what the market shape will be. But because of this correction, if the PE comes down, then all of a sudden the equation changes. From a premium market, it might become a discounted market. So this is where the opportunities might emerge depending on how the market moves from here on. So this is at broad indices level, right? If you're an ETF investor or index investor on Vested platform, you'll find more than 10,000 US stocks as well as ETFs. You can go and explore depending on your risk appetite. Now, coming to individual stocks for US stock market, let me first talk about Google. Why Google? I'll give you 1 to 2 minutes of commentary, which is extremely crucial from Mag 7 perspective and overall AI perspective as well. So if I type Google here and open one of the Google stocks here, okay, and if I click on trailing PE, what do you see here? If I go to 1 year period here, you will note that the PE of Google has dropped from almost 33 to now 25 or 24. Okay, depending on when you are watching this market, the data might have changed. But as of now, it is trailing PE is at around 25. A lot of damage has happened in Google. There may be further downside. I'm not denying that. But you need to understand why Google is all of a sudden under pressure. Okay, couple of points. So I wrote a detailed post on Google's recent announcements that came out because of their earnings, and the 3 key reasons that have spooked investors for Google. Number 1 is a negative free cash flow of around $5.9 billion. And this matters a lot to investors. If a company's free cash flow all of a sudden has gone down, it used to be in good billions dollars positive, it's gone down to negative now. Let me in fact show you the data here. Okay, so if I come back here and show you the data of free cash flow of Google, you will note that it used to be, for example, last quarter, $10 billion. Prior to that, $24 billion, right? It's all of a sudden gone to minus $5 billion. And investors have started asking question, where is this cash flow going now? All of a sudden, a company that was making good free cash flow, now they're burning cash. Okay, this is one of the reasons. Second is the capex. If you look at Google's capital expenditure, what you note is that it has been consistently going up. Okay, they have increased their forecast. For example, if I show you the data here, it used to be around $180 billion to $190 billion until last quarter, it has now gone back to $195 billion to $205 billion. So they're putting a lot of capex because the company sees the growth. But investors are asking a question, where is the return on this capital that you're going to put into the investments, right? That is second point. Third is likely to be also their ops margin going to compress possibly. That's what management is saying. All of these three reasons put together, what has happened is all of a sudden, if you go back here and look at the PE ratio, it has started to contract from 32, 33 to almost now 25. Now imagine a world where the Google's trailing PE might come down to 20 or might come down to 18. Okay. Will that be an opportunity? Well, it is up to you whether you're a long-term investor, short-term investor, what do you do with the AI theme, what is your confidence level? But in my view, if the valuations come down to like 20s or 18 PEs, and these are world-class companies, they're not going to go anywhere. These are temporary cyclic situations that might play out. Okay, tomorrow, if all of a sudden these capex start to give them some returns, then the reverse is likely to happen. Okay, so I'm giving you these examples so that you understand what is happening and why the stock market corrections could be good opportunities if you understand the game of valuations. Okay, let me give you another example of Microsoft. So if I type Microsoft here, and if you look at the trailing PE of Microsoft here, okay, it used to be actually at around 38, 39. Okay. If you look at 1 year history, it's come down to almost now 20, 22, 23, something like that. Okay. Again, there are reasons for Microsoft as well. For example, if I go and talk about Microsoft's some of the problems. Okay. So for example, if you look at the capex for Microsoft, again, the same story as Google. Okay. Every quarter, almost every quarter, their capex has gone up. Okay. Although if you look at their earnings growth rate has been very, very good for Microsoft. For example, if I talk about the latest quarter, the results, 23% diluted EPS has gone up by. The EPS has grown by around 23%. So that's not a bad number to look at. But at the same time, capex is going very, very high. Okay. And when that happens, if you look at the free cash flow, that comes under pressure. Free cash flow for Microsoft has come down by almost 22%. Can you see that? YOY? 22% down. Can it slip into negative? It is entirely possible. That is why some of the investors are going very, very bearish. If you go and look at Microsoft, it has not given any returns in 1 year. In fact, it is down. I can't quote the numbers here, but go and check it out for yourself. Now, if any further corrections happen in these companies, okay, and if the PE comes down to like 16, 17, then there is a question that do they become opportunities, right? This is how you need to evaluate. Again, if you have not started with your US investing, Vested is a wonderful platform. I am personally using it. I've given you the link in the description and in the pinned comments. If you open your account using my link, you're going to get $10 free after you do your first transfer. So that is on the US stock market. Let me come back to Indian stock market and speak about mid caps and small cap, because that is where the growth lies. And very, very important metric I want you to understand around valuations. Now, here is what you see for mid cap and small cap. Nifty Midcap 150 index or Nifty Small Cap 150 index. If you compare the current PE ratio of both of them, Nifty Midcap is at around 29.1 times. Okay. 5-year average has been around 29.9 between 31.1. So actually it is fairly trading as of now. Okay. Even before the correction have gone like deeply. Okay. If you look at Nifty Small Cap 250, current PE is very high, 35, almost 35, 36. Average has been around 26 to 28. So one could argue right now small caps are trading at premium valuation as compared to mid cap. Obviously, both of these indices have shown very, very good earnings growth rate. For example, mid cap estimated EPS growth rate last 12 months is around 20 to 22%. Small caps have been around 24 to 28%, even better than mid caps, right? But if you compare the valuations of both these indices right now, mid cap is my favorite right now. Okay. But tomorrow, let's say in the next 3 to 4 weeks, if the correction happen, I don't know whether the correction will happen or not. All of this is my theory because I feel that oil prices have gone up. So correction is likely to be there. Okay. I don't know how much correction can happen. If the correction happens, right? In my view, let's say Nifty Midcap P drops from 29 to 26, 25. Very, very good, healthy correction. Nifty Small Cap, if it corrects to 28, 27 P, very, very healthy correction. Okay, right now this is at premium. So this is how I go about looking at valuations and look at the EPS growth rate, look at the valuations and see if any of these opportunities because of the fear or the short-term pressure, the genuine pressure in the market, that could open up opportunities. And you don't need to be picking up mutual funds. Just simple ETFs do the tricks for you, right? Here are some of the mid-cap ETFs that I have sort of shortlisted. Around there are 7 of them. You can look at the 3-month average volume. I always start to filter out ETFs only based on volume first. Liquidity matters the most because then there is not much spread. Okay, so here 3 months average volume, you can see Mirai Asset, Zerodha, ICICI, Nippon, HDFC, all of them have good volume, but of course you can see, look at top 2 or 3. Expense ratio, you can see, for example, here 0.12 Mirai Asset, right? Zerodha 0.21. Tracking errors, you can see not much difference. Okay, very similar numbers. So volume to me is the most important thing, followed by the expense ratio, and if there are considerations around tracking error. This is how you can go and shortlist any ETF that you like, or of course you look at the INAV and the trading price. Again, I've spoken about that a lot on my videos. That is a very important concept for ETFs. I did a full podcast on my channel around ETFs only with Rahul Jain from Zerodha. This episode is a must watch if you want to really learn about ETFs. Go and subscribe to my Good to Great channel as well, podcast channel, where I bring a new podcast series on different categories now. So you're going to learn there as well. Okay. Overall, the market situation I have presented to you totally unbiased. I'm not saying you buy or sell or whatever. My intention is to show you the data, show you the picture that I'm seeing in from my eyes. I could be totally wrong here. I could be off, but I feel that market is genuinely under pressure, both India and US, because of the fears, which are very genuine. EPS growth is likely to get impacted if this war drags off, and the valuations, if they get corrected, in my view, they are going to open up a lot of opportunities if you're a long-term investor. With that, I hope to see you in my next video. Until then, keep rocking.